2022 is here, and with every new year means big changes to finances and businesses and our economy. And as many of you know, the beginning of every new year is tax season. But this year's tax season might not be as lucrative as it usually is. According to some experts, most Americans are actually going to get a smaller tax refund than they might have been expecting. In addition, there are some major changes that are happening to our tax code this year, and today I want to talk all about those tax codes and why you might not be getting a big tax refund in 2022. But before I get into all of that, my name is Nate from Minority Mindset News, and if you like this video, then smash that thumbs up button below and hit that notification bell too. That way YouTube shows our videos to way more money minds around the world, and we can keep making videos just like this one. All right, so let's jump right into why your tax refund might actually be smaller in 2022. As per the IRS, the tax refund that you end up getting all has to do with the amount of taxable income that you make in the year prior. Now, this past couple of years has been really strange as far as people making money. We have had a lot of stimulus checks. We've also had a lot of unemployment assistance, and we've had the rise of side hustles explode over the last few years. People have been starting to make a lot more money, and that means a lot less refunds are coming through. Now, there are a few different things that are going to prevent you from getting a larger tax refund than you saw in 2020. For some Americans, the first is going to be unemployment. Now, we had an unemployment rate of around 6.2% in 2021. That meant that there were millions of Americans who were unemployed all throughout the country, and they were receiving unemployment benefits. When you receive unemployment benefits, that is technically taxed as your income. I mean, that is the money that you're getting that you're then spending on all of your bills and necessary purchases. Now, depending on how much unemployment you actually collected in 2021, your tax refund will vary. Now, some Americans are actually going to see a larger tax refund this year because they were on unemployment for a longer portion of the year. Now, when you're on unemployment, you get a certain percentage of what you were making at your job before you actually lost it. It's important to note here that you're not actually going to make the full amount when you go on unemployment. You'll likely be making a lot less. But if you ultimately made a certain amount per year and then had your salary basically slashed in half, you may be getting a much larger tax refund in 2022 based on what happened in 2021. However, if you were only on unemployment for a very short period of time in 2021, or you managed to get a much higher paying job after you lost your job, then that refund is ultimately going to be smaller. And this is because we have a tax bracket system in the United States. Now, reading directly from the IRS's website here, let's go over some of the tax brackets and what you can expect to be taxed on in 2022. Here is the tax bracket system on the IRS's website. Now, you can see by this chart that depending on how much you make, a percentage of your income is going to be taken out for taxes. Most important thing that you can take from this chart is the percentage of the amount over a certain amount. So what I mean by that is you are going to be taxed at a different bracket after you've made a certain amount of money. One of the most common misconceptions that I see with taxes is that people look at these tax brackets and think, I make $40,000 a year. That means I'm going to be taxed 12% of my money, but that is not exactly true. For the first $9,950 you make in 2022, you will be taxed around 10%. And then anything over that, you will be taxed at 12% and so on. So after you've made $40,525 in 2022, you will be taxed at a rate of 22% for any dollar that you make beyond that point. So ultimately, the more money you make, the more you are taxed. So unemployment is going to play a huge factor because if you made a ton of unemployment or a very little, all of that adds up, and all of that needs to be reported to the IRS. Number 2, federal student loans. Now, mandatory federal student loan payments have been paused since March of 2020, and it looked like they were going to resume as of January 31st, 2022. However, President Joe Biden actually pushed this deadline to May 1st, 2022. Now, here's exactly what that means. Since March of 2020, around 90% of federal student loan borrowers have put their federal student loan payments on pause. That means that there have been millions of Americans not paying their federal student loans. So that means all of those borrowers who have not made a single federal student loan payment cannot write off the interest on their next tax return this year. Typically, borrowers of federal student loans can write off around $2,500 worth of interest on their student loans. Now, this will actually reduce the amount of taxable income that you have, meaning you can get a larger tax return, but this only applies if you pay your federal student loans. Now, it's important to mention here that this $2,500 tax write-off rule only applies to certain filers. If you made over $85,000 in 2021, you cannot write this off. So when it comes to federal student loans, the more you make, the less you can actually write off until that write-off is actually 0%. But according to some experts, if you are below that $85,000 a year threshold, you may actually get around $500 to $600 back on your tax refund, which is some serious money. But if you made over $85,000 in 2021, then this new rule doesn't apply to you. So sorry, doctors. Number 3, this one applies to all investors as we're talking about capital gains. Now, the stock market exploded in 2021. According to an article by Forbes, the S&P 500 actually gained around 26.9% in 2021. The Dow went up by around 18.7% and the Nasdaq grew by 21.4%. Now, what does this actually mean for you and your taxes? Well, that means that you gained a ton of money on your investments last year. Now, I know there were some rocky moments last year, but if you kept your investments all throughout the year, then you actually gained a ton of money. However, if you plan on pulling that money out in 2022 or beyond, you're going to be taxed on those gains. And because there were some huge gains in 2021, you're going to see a lot more taxes. And it all is going to depend on what type of account you actually have. Now, a mutual fund and an ETF that is not actively managed is going to have different taxes that come out of them every single year. A mutual fund may actually have more taxes because they are actively managed. Somebody is literally going into those accounts and making sure that all of the stock options that are in those accounts are making money, and they can see very high returns every single year. But they might not see as high of returns as a non-actively managed index fund or ETF. These accounts basically mimic certain indexes on the stock market. So you can basically have an index fund that tracks the 500 top companies in the United States, which is exactly like the S&P 500. Investing in a fund like this will give you exposure to all 500 of those companies without making individual investments. And you'll probably see some pretty high returns, which means if you decide to sell your investments through one of these accounts in 2022, you better be careful. The amount of capital gains you actually pay on an investment depends on how long you've owned the investment for and what you actually make every single year, so your yearly income. Now, the capital gains tax rates are a lot more simple than your typical income tax rates. Essentially, you will pay around 0 to 15% in taxes if you make less than $40,000 of income every single year. That number goes up to 15% if you make over $40,000 to around $445,000 every single year. So most of us are out at this point. And if you make between $80,000 and over $500,000 a year, you'll be taxed somewhere in the 20 percentile. So it all really depends on how much you actually made in 2021. So if you sold a portion or all of your investments in 2021, come tax time, you're going to have to pay the IRS a portion of that money. And the more you made, the more you owe. And finally, number 4, for all the parents out there, there was a child tax credit in 2020 and in 2021. This actually gave some American families hundreds of dollars every month, depending on how many children they had. Now, according to the American Rescue Plan that was signed by President Joe Biden back in March of 2021, the 2021 child tax credit went from $2,000 to $3,000 for all children age 17 and under, and parents could receive an extra $600 for any children under the age of 6. Millions of families ended up getting half of this money up front, which meant an extra $250 to $300 every single month. So for instance, if you and your family qualified for a $3,000 tax credit in 2021 and you have received around $1,500 of that so far, that means you can claim $1,500 on your overall taxes. So basically, the United States government gave you $1,500 and they still owe you $500, so you'll get around $500 from that on your tax return. However, if you received the full $3,000 up to this point, and you're probably going to get a much smaller tax refund because all of those tax credits have already come through. In addition, it all depends on your income once again. So the child tax credit and the amount of children that you have is going to determine what you actually get every single month and the refund that you receive come April. However, here is the most important thing you need to know about this child tax credit that was passed by President Joe Biden earlier in 2021. If you made over $95,000 in 2021, then you are no longer able to receive this child tax credit. In addition, if you started to make a lot more in 2021 and actually started to exceed $95,000, well, then you may actually owe the IRS money. This is because this American Rescue Plan and this credit was all based on 2020 numbers. So the amount of yearly income that you brought in 2020. However, you actually made a different amount in 2021. Some people made the exact same, some people made less, but a lot of people ended up making more. And if you made more than $95,000, then you may actually be charged by the IRS. So those are the 4 major reasons why millions of Americans might get a smaller tax refund in 2022 and they did in 2021. Next up, let's discuss the big changes that are coming to the IRS tax policy in 2022. A lot of you have heard that the IRS is now requiring banks and other financial institutions to report any amounts of money that flow into and out of patrons' accounts that are $600 or more. Basically, what that means is that if you get any kind of paycheck or send any kind of paycheck that is $600 or more, banks are going to have to report all of that information to the IRS. The IRS is then going to send you a 1099 form so you can report those earnings. Now, initially, there has been some outrage over this new rule by the IRS, simply because a lot of Americans feel that it is an invasion of privacy. Basically, any amount of money that you make is going to be scrutinized by the IRS, but it is a little bit more complicated than that. The main reason why the IRS is instilling this new rule is because there were millions of people throughout the country, business owners and regular Americans alike, that were using tax loopholes in order to not pay taxes, essentially evade their taxes. Basically, you have millions of Americans who are getting paid under the table, which essentially means that there is no taxes involved. They're basically just being paid with no contracts and only in cash. You also have a ton of payment platforms like PayPal and Venmo who are not charging taxes on transactions. This means that businesses who operate using Cash App and Venmo are able to keep 100% of the funds that they accumulate from these apps. And what is basically happening is you have thousands of businesses all throughout the country who are not paying any income taxes. You have small businesses who are basically evading taxes because of IRS loopholes. This new $600 banking change essentially closes that loophole. Now, anybody that makes $600, no matter what it is going to have to report that information to the IRS. And I know exactly what you're thinking already. So we're going to start taxing teenagers who babysit kids? Well, kinda. If these teenagers are going to make over $600 a year, then technically the IRS is going to know about those transactions. And they're going to know that that babysitter makes over $600 a year. The reason being is because if the teenager makes that money, then they're going to have to put it somewhere, and the IRS wants you to put it in a bank account. This way the banks can track every single transaction and make sure that income is being tracked properly. However, the IRS has not technically said that they're going to tax you on that $600. All the IRS is going to do here is monitor what you are actually making. And this new rule isn't for all of the people who are selling things on eBay, or all of the babysitters, or all of the thousands of small businesses on Etsy. This is more of a rule for the medium-sized businesses who are making $10, $20, $30, and even $50,000 a year and not reporting any of that income to the IRS. So it's going to be strange if you make $1,000 a year from a side hustle filling out a 1099 form, but ultimately, no matter what you do in the United States, if you make money, you have to report that information to the IRS, pretty much no matter how much it is. You can argue whether that is a great rule or a terrible rule, but at the moment, that is the way that things are. And finally, I want to mention a new controversial tax rule that is being explored in 2022. Back in November of 2021, when President Joe Biden's $1.2 trillion infrastructure bill was passed, Congress started to look at brand new ways to fund this new bill. One of the ways they've come up with paying for this new bill is all through taxes. President Joe Biden initially talked about a new capital gains tax. He talked about pushing that all the way up to 40% for some of the highest earners. However, that measure did not make it through Congress. Congress itself has also mulled over the idea of taxing cryptocurrencies in a brand new way. And finally, Congress has talked about a new mileage tax that would basically tax you per every single mile that you drive. And I want to make one thing abundantly clear right now. Those three things that I mentioned haven't actually been passed in Congress, which means they are not law, and the taxes involved with them are not set right now. When you sell a cryptocurrency, it is basically taxed like a property or other types of assets, like a stock or real estate. However, right now there is no across-the-board federal tax rule that involves how many miles you drive. That is something that is currently being tested by the United States government to see how it would work, how refunds would work, and so on. And you might be thinking that this new auto tax is something completely random. However, in the infrastructure bill, it proposes a lot of changes to our roads and to our electric infrastructure, which is going to greatly impact the drivers and the vehicles that are on our roads every single day. That means the new mileage tax would essentially pay for all of the changes that Congress wants to make. And one other thing that I want to make abundantly clear is that if you can make money on it, or if it exists in the United States government is going to find a way to tax it somehow. Taxes essentially fund everything in our society. That is the only way for governments to make money. I mean, sure, the United States government is a currency issuer. The Federal Reserve prints money for the federal government to use. However, the federal government needs to pay all of that money back. And the reason being is because all of that money goes to private institutions more often than not. And ultimately, all of that money is going to go to private citizens. So even if it does go to a government institution, it's going to be paid to someone. That someone is then going to take that money and most likely isn't going to buy things that are government related. They're going to buy things for personal use. So keeping the idea of taxes in mind, it's important to know that anytime you receive money from the government, pretty much always you're going to have to pay some of that money back. No amount of money is free, and taxes are pretty much always going to exist in our society. And the IRS and our federal government changes how our tax code is written almost every single year. This is because every single year, the federal government passes more bills, and then they figure out later that they need to find new creative ways in order to pay for those programs. And there was a lot of money that was printed in 2020 and in 2021. So as people get more money, the amount of taxes that are going to be taken out of people's paychecks is going to go up too. So you can expect that to happen in 2022 and probably beyond. But now I want to hear from you on this issue. What do you think about the new changes that are coming to the IRS and taxes in 2022? Do you think that they are a great thing, or do you think that taxing needs to be a lot less? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you liked this video, make sure to hit that subscribe button below. Keep hustling, money minds, and I'll see you all in the next one.